Now I'd like to continue taking a look here at the bigger picture because Angela Sloan is with us, CEO, founder, Sloan Financial Group. What I think is interesting is how you're pointing out not one, but two bear markets, and you're not sure when it ends here, right?
Right. It is kind of odd. We've seen two in, just a little over 2 years. And like I've said before, I'm not convinced that this is over yet. And if you look at history and you look at the numbers, I would bet that this thing is not over yet.
So what are you watching for? I mean, what would be the indicators to you to say, hey, I'm going to start nibbling in the market?
Well, look for bargains that are out there. Let's kind of backtrack for, the last 6 months. Coming in from 2021 into 2022, we thought we were going to see some modest economic growth, and we thought inflation was going to be temporary. Well, that's proven to be untrue. And that's what threw the monkey wrench in the growth was people became aware that, hey, this inflation is not temporary. It's going to be here for a while, and it's going to be really bad. And that was just the monkey wrench that's thrown right into any growth that we could see coming. As usual, the Fed showed up late to the dance. They started trying to raise interest rates. I think they did too much too fast. And it's just caused inflation to be worse. That and supply chains, according to the Feds, was supposed to get inflation under check, and it just has not done it. And we have seen the worst inflation that we've seen since the 1970s. So, rising prices are eating at our paychecks as inflation has outpaced the gains, which has sparked the recession. Or recession concerns, I should say, as households brace for even more inflation at maybe even a faster pace. And as these conditions are eating into their paychecks and lead to corporate cutbacks, and as the economy teeters, markets have tanked. And the markets had their worst first half of the year since 1970. So, they're suffering their second bear market in just over 2 years. And even gold has not held up to inflation. Remember, you always use gold for the inflation hedge, and in some cases, you would use bonds to lessen your risk. But if you had invested $10,000 in gold at the beginning of the year, it would have fallen to $9,550 by the end of the second quarter. So even gold has not held up to inflation, and then people would resort to.
Wait, okay, you're giving us so much great information, and I want to make sure that our viewers are taking away each and every point. Because it's so much to really digest. Yeah, it's so much to digest. I understand. I think one point that you've made is that the markets can recover quickly. And yes. So what should an investor shouldn't be sitting on the sidelines, just sitting there in cash, right?
That's correct. So right now there is a lot of cash sitting on the sidelines. Your mutual funds and your hedge funds, they are sitting on a lot of cash. And I think it's good to be sitting on some cash right now because you need to be ready to take advantages of the bargains as you see, bargains come up. So I want you to bear in mind that since 1957, when the S&P had a negative first half of the year, there was a 50% chance that 50% of the time, the markets were negative the second half of the year, which means you got a 50-50 chance it's probably going to be negative the rest of the year. So not to mention that we're dealing with things now that we didn't deal with in 1950, okay? We're dealing with the border surge and cryptos and the weakest leadership we've ever had. Then there's the crime surge and the supply chain issues, the pandemic, and it just goes on and on. Yeah. So even if you go back, if you go back to 1980, you go back 42 years, we've come through all these things, and we have not had to deal with these type things in the past. So it is different this time.
Okay. So well, I'd like it people to take from your expertise. I'd like to have people take from your expertise rather than pulling their hair out and thinking about the bad news upon the bad news upon the bad news. I'm sure, as you said, some cash can be put to work at some point. What would you advise?
Well, in June, for example, Berkshire Hathaway, they bought $51 billion in stocks at the end of June. And Warren Buffett said, we had a chance to do something, and it wasn't because we were smart, it was because we were sane. So just use your common sense. When you see that a big company that is not going to go away, but the stock is extremely low, that may be a good buy. Now may be a good time to do it. Maybe you'll sit there and watch it for a little while, because I'm not convinced that the bottom has hit yet, but there are still some good bargains out there. You don't have to necessarily wait for it to fully hit bottom. One of the key takeaways, Nicole, is that the market usually gains more than it loses, okay? Since 1980, 42 years, the S&P gained 32 of those years and it lost 10 years. So of those 42 years, it gained 32 of those years. The other takeaway
also,
is that the market,
the Fed's trying to make some moves here to help things along, right?
Well, they're trying, and that's part of what the problem is. You have investors trying to guess how fast and how much more the Feds are going to raise rates, and that's causing a lot of this volatility. But bear in mind, another takeaway is that the markets can recover quickly. In 1987, in 2009, and I think in 2020, we had huge market losses. Yet the market closed each of those years in positive territory by the end of the year. So when the market turns around, it can turn around very quickly, especially if you're doing dividend reinvestment right now and you're purchasing more shares with your dividends. Then those shares are, you're building your share amount. So when the market does turn around, it's going to take off like a scalded dog. But you got to remember, this takeaway is you may get hammered in the near term. Okay. The only 6-month performance numbers that were worse than what we just lived through, the only time it was worse was the Great Depression, the 1937 crash, World War II, the 1970s bear market, the dot-com bubble, and the 2008 crash. Those times were worse, and this could turn out to be worse than any of those. So I'm still not convinced that we've hit bottom, and just bear in mind, you're going to get hammered in the near term. Average rarely happens. You hear people say, here's your other takeaway. Oh, the market's averaged 10%. Well, that's true, but there are very few years when the market rose by that 10%. So that average comes from this. You had some years that were better than average. You had many years that were lackluster, and you had a handful of lousy years. And I think this is one of those lousy years in that handful.
Yeah.
So you just
Angela
look for
Sloan,
bargains.
thank you so much. Thank you very much. Angela Sloan, CEO, founder of Sloan Financial Group. Nice to chat with you, Angela. Thank you.